Are you selling covered calls, but you're struggling to figure out how to structure your portfolio around those covered calls? Well, in this video, I'm going to share with you my portfolio model. So this way you can go and see how to allocate assets when you're selling covered calls against your shares of stock. If you don't know me, I'm Sasha, the options coach, and I've been coaching people to trade options over the last 10 years. And I've helped a lot of people from one-on-one, from financial managers to even regular retail investors. So let's take a quick peek here at this portfolio profitability model. And what I want to do is go in detail of showing you how this kind of works and give you a little insight. So a lot of people do a portfolio more kind of like this, and they look at it from a, call it a pie shape. And I think that's kind of normal from what a lot of money managers use, but I don't think it's as appropriate for most people because we get trained and our habits looking in those portfolio models kind of, gets numb. So I like looking at it from a triangle basis. And this is what we've got in terms of the portfolio, is that we've got kind of three zones that I like to look at if you're selling covered calls. And this can apply to a lot of other asset classes as well, from verticals, iron condors, and so on. But you might have three different zones, like a long portfolio, medium portfolio, and a speculative portfolio. And what does this really mean? Well, with a long portfolio, we're looking for a positive move in delta, which usually is referring to an up appreciation in terms of a stock price. Okay, a medium portfolio, we're looking for a little bit more theta heavy trades. Okay, where we're looking for a little bit more of a sideways direction, and speculative is kind of more like your guess, could be shorter duration, could be based on technicals a little more so. So how does this fit in a little bit with covered calls? Well, here's what happens. Is when we have a little bit of a positive delta or we're looking for long portfolio, this might be things that are 60 plus days in duration. Okay, it also means we're going a little further out of the money with our covered call trades. Okay, that's what allows us to have that positive delta, and we're looking for longer term appreciation for a bit longer term. With a medium portfolio, what we might actually do is, because we're looking for a little bit more of a theta game here, we're looking for more closer to at the money. We're looking to defend that stock a bit more. And it could also be between 30 to 60 days, but you're going a little bit shorter duration. So somewhere around that 30 to 60 days. And then the speculative trades, we're going with 30 days or less. It could be just a week where you're rotating covered calls. It could be just for a day even. Maybe you do it on a Friday and you just do it for that day and you're rotating that position. So this allows you to have a portfolio that's a little more balanced and has some equilibrium to it, because that way if stocks go down, your long duration or long portfolio is still going to be okay. Or if things are moving sideways, you're going to have a nice income stream from the theta. So it spreads that risk in different zones and areas. Now, if you look at it as far as risk levels, the highest risk level is going to be the speculative. Long portfolio is going to be the lowest risk because you're holding things for a longer duration. So that's kind of the range. And as far as return, this will vary obviously depending on the stock movement, as well as how far out you go and the duration, and as far as option premiums go. But again, you're going to have the highest risk on the speculative, so you'll have a much greater return, and the lowest risk, is going to be on the longer portfolio. So this will vary. Capital allocation, you might vary on this depending on market conditions, but long portfolio might have about 50%, medium might have 30%, and speculative could be 5%. And then you could have some cash on the side to allocate as things drop or move against you. And that will also depend on if we're at all-time highs. So at all-time highs, you might have a little less on the long portfolio, like let's say 30%. At all-time lows, you might put a little bit more in there. Now, there's a lot more to cover in here as far as the subject matter. But if you want the PDFs, just drop me a quick note down below and I'll send them over to you. And I've got some other material on here, but I just want to show you this insight as far as portfolio goes and how this really works, because a lot of people don't see it that way and they kind of look at pie-shaped diagrams, and I find that's not as a good fit. So just drop me a note if you're interested in this. I'll send you the PDF. I don't have it on a website or anything. And hope this helps and gives you some insight as far as understanding how a portfolio might work in your own asset classes and your trades.